This month, thousands of Canadians are about to renew their mortgage and quietly see payments jump by $400 to $800 a month without buying anything new. Welcome back to Canadian Wealth Lab, where we break down how money, housing, and the economy actually connect. Canada is now in the middle of a massive mortgage renewal wave, and it peaks in 2026, even with the Bank of Canada holding its policy rate at 2.25% as of April 2026. That number hides a deeper shift in how mortgages are priced today. This is no longer just a rate story, it's a renewal story. Today's reality is a locked-in financial reset many are not prepared to handle. Let's break this down in the lab, because the math is where this becomes real. Imagine a homeowner with a $400,000 mortgage balance. In 2021, at a 1.9% fixed rate, the monthly payment was roughly $1,675. Today, at a renewal rate closer to 4.5%, that same mortgage jumps to over $2,100. That is a $450 increase every single month, nearly $5,400 a year, just to stay in the same home. For larger mortgages of $500,000, that increase can reach $750. And here's the part most people don't understand. Even if rates pause, your payment doesn't. You might see the Bank of Canada staying on the sidelines, but fixed mortgage rates don't answer to the central bank. They follow the 5-year Government of Canada bond yield. As of May 2026, recent upward pressure on yields has kept fixed rates elevated. This means your renewal rate can stay high, or even climb, no matter what headlines you're seeing about rate cuts. At renewal, you are not just choosing a rate, you are choosing a risk. To navigate this, consider these tactical shifts. First, the re-amortization option. Some lenders will allow you to stretch your remaining balance back out to 25 or 30 years to lower the immediate monthly cliff. However, the mathematical cost is high. You're signing a longer debt sentence and paying thousands more in total interest. Second, consider the variable pivot. In many lender offerings as of early 2026, variable rates are running roughly 0.5 to 0.7% lower than fixed rates. Because many variable rate borrowers have already been absorbing incremental hikes since 2022. They may face less of a sticker shock than those coming off of ultra-low fixed rates. There is no perfect option here, only trade-offs. In 2026, managing wealth is shifting toward mathematical precision. The renewal cliff is not a theory. It's already showing up in people's monthly payments. More than 1 million Canadian mortgages are up for renewal this year. This shift is creating a widening financial divide between those who can absorb the increase and those who simply can't. You cannot simply wait for a price drop to solve your affordability problems. In this market, the cost of money matters more than the sticker price of the home. If your renewal notice is coming this month, your job is to stress test your own budget before the bank does. Understand the mechanics of the trigger rate if you go variable, and evaluate the interest rate differential penalty if you lock into a long-term fixed rate and need to move early. Your financial resilience must be tested, not assumed. If this breakdown helped you make sense of the Canadian market, hit the like button and subscribe to the lab. We are tracking these shifts every week so you can make smarter moves with your money. What are you seeing in your area? Are people talking about renewals or avoiding it entirely? Let's talk in the comments, because in 2026, the real divide in Canada won't be home prices. It will be who can still afford the payment when that notice arrives in the mail.